Have you ever felt that gnawing unease, a silent whisper in the back of your mind, wondering if the ground beneath your investments is truly solid? It's a fear that often comes not from a lack of effort, but from a profound sense of inadequacy, a feeling of being blindsided by forces unseen, like a ship caught in a sudden storm after days of calm, leaving you adrift in uncertainty. This unease often stems from the ghost of market cycles past, the phantom pain of capital lost when the air went out of an overinflated asset. It's the silent killer of overlooked market bubbles, quietly eroding the foundations of our financial peace. Many believe market bubbles are anomalies, rare events we only recognize in history books, or worse, only after they burst, leaving a trail of shattered expectations and broken dreams. But what if the signs are always there, subtle at first, growing louder, like a distant rumble before a tremor? What if the wisdom to discern them has simply been obscured by the clamor of superficial narratives and the siren song of easy gains? Benjamin Graham, the very architect of intelligent investing, taught us to anchor our decisions not to the fleeting currents of market sentiment, but to the unyielding rock of intrinsic value. He showed us that the market, in its short-term madness, often confuses price with value, a dangerous delusion that fuels every bubble, making fortunes on paper only to dissolve them in the harsh light of reality. Today, we embark on a journey to uncover these hidden truths, to demystify the mechanisms that inflate and deflate market segments, often to the detriment of the unsuspecting. We will explore not just if bubbles exist, but how to identify their nascent forms, transforming that gnawing anxiety into a quiet, confident certainty. This isn't about predicting the exact moment of collapse, but about developing a skeptical, data-driven framework that allows you to see beyond the headlines, to truly understand the why behind market movements, and to shield your investments from the coming storm. This path empowers you to transcend the often contradictory noise of conventional financial advice, to forge your own independent, informed decisions, rooted in genuine understanding. It's an invitation to cultivate an intimacy with data-driven truth, to embrace the long game of sustainable wealth creation, and to walk with the quiet strength of informed decision-making. We are uncovering the hidden truths behind wealth accumulation, showing you how to challenge the consensus, find your edge, and build a portfolio rooted in genuine value, not fleeting speculation. Don't just invest, understand the why behind every decision, allowing your actions to flow from a place of deep knowledge and calm conviction. There is a silent fear that often clutches the heart of an investor, a deep anxiety that arises when market momentum becomes the sole compass, overshadowing fundamental reality. This is where anchoring bias takes root, a subtle cognitive trap that makes us cling to inflated prices, believing a peak is true value, even when data whispers otherwise. We become anchored to illusion, ignoring the gathering storm. How often do we hear, "This time is different," or "high growth justifies any price"? History, however, repeats its lessons. Recall the dot-com era, where P/E ratios became fantastical, detached from tangible earnings, or the Nifty 50 stocks. These were psychological traps, luring investors to believe gravity had suspended its laws. Is your diversified portfolio unknowingly concentrated in these bubble narratives? Benjamin Graham taught us that, in the short run, the market is a voting machine, swayed by emotion and fads. But in the long run, it is a weighing machine, assessing intrinsic value. During a bubble, the market abandons its scales, becoming a chaotic ballot box where speculation, not substance, casts the decisive vote. This changes everything about how we perceive asset pricing, urging us to look beyond the popular vote. To discern genuine value from speculative froth, embrace a three-step fundamental analysis. First, normalize earnings over a full business cycle, revealing sustainable earning power. Second, reverse engineer the growth expectations implied by the current market price. Does the valuation demand unrealistic growth for decades? Third, compare valuation multiples against historical industry averages and replacement costs. When prices soar far beyond these rational benchmarks, it signals overextension. During a bubble, the market is like the emperor in his new clothes, parading magnificent garments that only exist in collective imagination. Everyone praises the invisible fabric, but the truly data-driven investor, with courage born of deep analysis, dares to point out the nakedness. It requires quiet strength to stand apart from the crowd, trusting your insights over intoxicating consensus. Are you willing to be that discerning voice, to protect your wealth by seeing what others choose to ignore? A silent distrust often stirs within investors, emerging when central bank policies or government interventions, seemingly benign, inadvertently cultivate conditions ripe for market bubbles. This realization makes one question the market's integrity, sparking a deep desire to understand its hidden mechanics, moving beyond passive acceptance of narratives. There's a pervasive myth that low interest rates are always good for stocks, or that quantitative easing is purely stimulative. History, however, reveals a different truth. Excessive liquidity, like an overflowing river, often spills into speculative speculative assets rather than productive investments, creating asset inflation without corresponding economic growth. We've seen this repeatedly, where cheap credit fueled a mirage of prosperity. This shatters the expectation that market liquidity automatically equates to market health. The counterintuitive truth is that abundant, cheap credit can actually be a leading indicator of speculative excess. It masks underlying systemic risks, lulling investors into a false sense of security, much like a calm sea hiding treacherous currents. Beyond the headlines, what's really driving the market? Often, it's the invisible hand of liquidity, shaping perceptions more than reality. To navigate this liquidity mirage, we employ a strategic, analytical technique. First, track the credit impulse, the rate of change in new credit creation. A rapidly expanding impulse often precedes speculative surges. Second, analyze yield curve inversions, a powerful signal of future economic contraction that often foreshadows tightening liquidity. Third, observe the spread between corporate bond yields and government bonds. A narrowing spread indicates heightened risk appetite, often fueled by easy money. This methodical approach empowers you to anticipate shifts in market sentiment before they become undeniable. Warren Buffett famously observed, "Only when the tide goes out do you discover who's been swimming naked." This analogy perfectly captures the essence of the liquidity mirage. Easy money, the high tide, conceals poor investments and excessive risk-taking, allowing even unsound ventures to float. But when liquidity dries up, when the tide recedes, the naked truth of over-leveraged positions and fundamentally weak assets is brutally exposed. Are you prepared to distinguish between genuine value and mere buoyancy before the tide turns? Even experienced investors feel a pull, a subtle urge to join the trend, doubting their own data-driven analysis during euphoric markets. This feeling of investment inadequacy stems from deep psychological traps, often leading to market underperformance. It's the quiet struggle between your truth and the surging crowd. Our minds are wired with biases that, during a bubble, become dangerous blind spots. Confirmation bias makes us seek only bullish evidence. Anchoring bias fixes us on past highs. Loss aversion makes us cling to losing positions too long. Overconfidence leads to inadequate due diligence. These biases amplify herd mentality, making it incredibly difficult to sell or avoid overvalued assets, pulling us into a collective delusion. This shatters the expectation that individual rationality prevails. The counterintuitive truth is that collective irrationality mania or panic can dominate, driven by neuroemotional factors. Dopamine surges from winning in a rising market can override logical analysis, leading to impulsive decisions, blinding us to risk and the true value of sustainable wealth. To heal these behavioral blind spots, we embrace a mental model from Daniel Kahneman's asterisk thinking, fast and slow asterisk. First, recognize your system. One impulse is the fast, emotional urges to chase returns. Acknowledge them, but don't obey blindly. Second, force your system to the slow, analytical thinker to engage. Pre-commit to clear valuation rules and exit strategies asterisk before asterisk emotions run high. This creates a vital guardrail. Third, implement a pre-mortem exercise for potential investments. Imagine how this investment could fail in a bubble scenario. This inoculates you against your own biases, fostering informed decision-making. The lemmings to the cliff metaphor serves as a stark reminder. Just as lemmings are believed to follow each other to their doom, investors caught in a bubble often follow the herd, driven by fear of missing out and social proof. They ignore the precipice until it's too late. This underscores the vital importance of independent critical thinking. Are you willing to cultivate the inner strength to stand apart, to trust your own reasoned judgment when the crowd charges headlong towards the edge? The frustration stemming from incomplete or superficial financial education often leaves investors vulnerable to compelling, yet ultimately flawed, market narratives. There's a deep desire to deconstruct these stories, to find the underlying truth beneath the surface. It's about seeing past the illusion to the genuine mechanisms at play. How often do we hear that new paradigms always supersede old valuation rules, or that this technology changes everything without examining fundamental economic moats? Think back to the narratives of the dot-com bubble, where the internet will change everything became a mantra, or the 2008 crisis, where housing prices never go down was gospel. These stories, potent and pervasive, become self-reinforcing, providing a psychological justification for unsustainable asset appreciation. They are powerful fictions that can blind us. This shatters the expectation that financial news and mainstream media offer objective analysis during a bubble. The counterintuitive truth is that media, driven by viewership and advertising incentives, can amplify speculative narratives, creating a narrative contagion. This contagion distorts perception and fuels fear of missing out, or FOMO. Don't just invest. Understand the why behind every decision, especially when the why is a captivating but unsubstantiated story. To discern genuine innovation from speculative hype, we employ a three-step critical thinking technique. First, clearly identify the story being told about an asset or sector. What grand promise is being made? Second, cross-reference this story with historical economic cycles and fundamental principles. What are the actual returns on capital? Does the company possess a sustainable competitive advantage? Does this truly defy economic gravity? Third, actively seek dissenting voices or data points that contradict the mainstream narrative, applying a skeptic's filter to all information. Challenge the consensus. Find your edge. The Pied Piper analogy vividly illustrates this. During a bubble, a charismatic narrative acts like the Pied Piper's tune, leading investors, often against their better judgment, towards speculative assets. It promises prosperity, but ultimately leads to financial loss. This highlights the immense power of storytelling in markets and the critical need for rational discernment. Are you willing to listen for the discordant notes in the melody, to protect your investments by trusting your own critical analysis over a captivating but dangerous tale? There's a deep-seated fear of financial loss, compounded by a distrust of financial authority, that arises when investors realize even large institutions can be caught in bubbles or even contribute to their formation. This makes independent decision-making feel daunting, yet it also ignites a desire for financial mastery that doesn't rely on blindly following others. We seek genuine pathways, not just well-trodden ones. Society has subtly distorted the image of the independent, data-driven investor, often promoting the idea that following institutional smart money is always safe. This is a dangerous simplification. The truth is, institutional mandates, benchmarking pressures, and career risk can force fund managers to participate in bubbles, even when they privately recognize the dangers. They become rational lemmings, compelled to follow the herd to protect their jobs, not necessarily their clients' capital. We're uncovering the hidden truths behind wealth accumulation, showing that what appears smart may simply be compliant. This shatters the expectation that institutional buying validates high prices. The counterintuitive truth is that institutional herding can actually be a contrarian indicator at market extremes. Retail investors, often the last to join the trend, frequently buy at the very top, just as institutions are quietly distributing their holdings. This changes how we interpret big money moves, urging us to question, not just follow. Is your diversified portfolio truly diversified, or is it merely mirroring institutional overexposure? For daily life, develop an anti-benchmark mindset. Instead of comparing your portfolio to market indices during speculative phases, focus on your absolute returns relative to your personal financial goals and the intrinsic value of your holdings. Your wealth journey is unique. Implement a reverse due diligence on popular institutional holdings, scrutinize balance sheets and cash flow statements for signs of distress, looking for red flags that the collective might be overlooking. This empowers you to make truly independent, informed decisions. The King Midas paradox perfectly illustrates this illusion. During a bubble, everything the smart money touches seems to turn to gold. But just as Midas eventually starved because his food turned to gold, blindly following this touch can lead to financial ruin when the illusion of value collapses. You're left with golden, but ultimately worthless assets. Challenge the consensus. Find your edge. Will you cultivate the discernment to see beyond the golden touch to protect your true wealth? We have journeyed through the subtle currents of the market, uncovering the hidden truths that often lie beneath the surface of apparent prosperity. We've learned to recognize the silent signals, the valuation distortions where earnings become fairy tales and prices defy gravity. The deceptive com of the liquidity mirage where easy money fuels speculation and masks systemic risk, and the insidious behavioral blind spots where even smart investors can fall prey to the herd mentality. Each of these reveals a facet of the market's true nature, challenging us to see with greater clarity, to move beyond the superficial, and to embrace a truly skeptical, data-driven approach. True financial mastery, a state of quiet confidence and enduring peace, does not come from the futile pursuit of predicting the exact timing of a crash. Instead, it blossoms from the consistent application of sound principles of strategic finance and value investing, the kind championed by the quiet wisdom of Warren Buffett and Benjamin Graham. It is about building an inner fortress, brick by brick, with intrinsic value as your mortar and a margin of safety as your foundation. This is the path to protecting and compounding capital, not just for a season, but for a lifetime. The pain of past market downturns, the sting of being caught unaware, can transform from a wound into a teacher, guiding you towards a deeper understanding. This understanding empowers you with the quiet strength to execute independent, informed investment decisions, unshackled from the clamor of the herd and the relentless noise of mainstream narratives. It fosters a profound sense of control, a deep security that comes from knowing you are navigating the market with your own compass, calibrated by data and anchored in enduring principles. You are no longer tossed by every wave, but charting your own course. Consider the skilled navigator standing on the deck of their vessel. They do not fear the vastness of the ocean, nor do they panic at the sight of distant storm clouds. Instead, they understand the currents, they read the weather patterns, and they heed the warnings of the changing winds. They know that sustainable passage is not about chasing every fleeting wave, but about charting a steady course, adjusting for the inevitable storms, and always returning to the fundamental principles of navigation. Will you choose to be such a navigator, trusting your own data-driven compass, even when the siren songs of speculation beckon and the crowd rushes headlong into the fog?